Welcome to Euroz Hartleys Finding the Front, where we get to know the people who front some of Western Australia's leading companies, providing you with real insights into the way they think and approach things, both in business and in life. So get the volume adjusted in your car or your headphones sorted and settle in for a great story. Here's your host, Tim Banfield.
Hey everyone, and welcome to a special episode of Euroz Hartleys Finding the Front. As a proudly Western Australian company, each year in March, Euroz Hartleys holds our annual institutional investor conference at beautiful Rottnest Island, a short boat ride off the coast of Perth. The conference has been running for some 25 years and is seen across Australia as a standout event in the calendar for small to mid-cap fund managers, where they can hear from and interact with our WA-based ASX-listed company clients who present back-to-back over a 3-day period. It really is an outstanding few days. In the lead up to this 26th annual Institutional Investor Conference, in this episode of Finding the Front, we take the opportunity to have a brief chat to 3 leading Australian small cap fund managers who will be attending the conference to learn their thoughts and insights on investing and how they are approaching what could be an interesting year ahead. Please remember, as always, the contents within this episode is general information only, and to seek professional financial advice before making any investment decision. So let's get started. Our first guest is Andrew Mitchell, who is the founder and senior portfolio manager of Ophir Asset Management. Andrew has over 20 years' experience in portfolio management of listed companies, stockbroking, and economic analysis. Andrew, it's so great to have you on Finding the Front in the lead up to the Euroz Hartleys Institutional Conference, and looking forward to seeing you at Rottnest Island. I know you're a big supporter of the conference and you've been attending for quite some time. So, yeah, you're looking forward to it.
Yeah, I reckon my first one was 2008. And I think I've missed, well, they would have missed COVID and maybe one other. So how many is that? I'd be coming up to, what, 14, 15 or something like that.
Fantastic.
So
yeah, tell me,
Mac has done more than me. There wouldn't be too many.
Tell me, what do you get out of it? Just like for those who have never attended.
Look, it's changed a lot. It's changed a lot. Like I remember when we were in that old sort of dusty room, it's hot and there's the fan going and there's a toilet where there's basically a door just going into the toilet at the back of the room, and we're all crowded in there and eating ham and cheese croissants that were cooked about 2 hours ago out of a bain-marie. It's changed a lot, but for me it's access to management right after reporting season. So we've just had the half-year reports. The companies have just come out with the quarters. They've got stories to tell, and it's a great opportunity to see lots of great Western Australian companies that maybe find it harder to get over east. And then the ability, I remember we used to have the raft up, that's gone away. It got too big where we used to get 3 sort of those boats and put them all together. But it's just great to share a beer with the different CEOs, CFOs, investor relations, get to know them a little bit more personally. And just have a chat, about the business and maybe some of the softer stuff about the businesses, the challenges they face. And yeah, I look forward to it every year. And what a great setting. Like Rottnest Island is just such an amazing place in the world. My friends are all very jealous. I've been there 15 times.
Well, look, that's a great place to start. Thanks again for taking your time out. Ophir's investment philosophy is to provide a commitment to offering clients high-performing investment strategies. And they're underpinned by a value proposition that are common across all.
Is that written somewhere, Tim? Because it's very good. I've never heard that, but I'll agree with it.
Well, it's across all 4 Ophir funds. Now, it started out with your longest running fund, the Ophir Opportunities Fund. And that's the one I want to concentrate on. Long only, small cap Australian equities fund, showing a compound annual rate of return since inception of 23.7% to the end of January.
After fees,
After fees, that's right. So, look, I was just hoping you might be able to give us a brief overview of the fund and what's been driving performance over the last 12 months. And because the fund's had a great well, it's up around 33% to the end of January for the last 12
Yeah.
months. So it gives us a bit to talk about. How have you seen the last 12 months? And that'll draw us to the next 12 months.
So I would break last year, the last 12 months anyway, into
Yes.
two halves. The first half is the market searching for growth and buying a lot of the same names that kept delivering. This is the Australian market. And so people were squeezing into these same names that were doing very well. Think Life 360, Generation Life, maybe Zip as well. Squeezing in, valuations going higher and higher. And then we roll to August, September. Trump, the market becomes worried about the US dollar. Trump is very clear he wants a weaker US dollar. The market's worried about the independence of the Federal Reserve, new Federal Reserve governor coming in, obviously,
Yes.
and what that does for the US dollar. Now, obviously, a weaker US dollar is great for commodities. A stronger global backdrop is great for commodities. EV, obviously, great for some of those battery metals that we look at as well. And we're seeing commodities really rip. And the Aussie market has switched out of those crowded names and into commodities. And we've seen this huge disparity between resource companies, which are now about 35% of the small cap index. I could be a bit wrong, depending which way you cut it. It's up considerably, and it's been a bloodbath for a lot of great Australian managers trying to navigate that. And then you put on top what AI is doing, the question marks it's putting on the terminal value of all these software companies, any tech company. We've seen a big bloodbath there as following, really from January, as that's got steam with the Anthropic release. So it brings us to today, and we're sitting here with Israel and the United States waging war that I don't know how it ends, with Iran, and what that does to energy prices. I can keep talking about what I think about the future, but I think in an AI world, resources, we know, hard assets, they are always going to be valuable. There are a lot of question marks about the best companies in the world and Australia. Who's going to win? Who's going to be disrupted? And we're not going to know for some time, but the valuations come down because the market hates uncertainty. So that terminal value gets reduced. Resource companies, well, we're going to need a lot of copper to build those data centers to fund the AI. We're going to continue to need iron ore to build the infrastructure around the world. Gold's a great safe haven, obviously, for that currency thing. That is always going to be valuable. Hard assets are going to be valuable. And so the market is increasingly confident on those resources. And just to talk about what's happening now, well, I'll let you go to the next question, but I can talk about what's going on right now.
I think that brings us up to speed. But then looking forward with the Ophir fund, the Opportunities Fund, where are you positioned? Where do you see sectors that could be of value? And what's a stock, say, for example, that our listeners might want to observe over time to just get a feel for that?
Okay, yeah. So where Ophir is positioned at the moment, we've always been underweight resources. We've got basically a peak weight that we would have in resources, which is 10% plus, not much more than 10% under the index. And we're also in the more quality companies. We've been in a long time. We've been following Rally at Genesis since it was $1 a share, and we've owned a lot of that company, and Aura Banda and the great management teams. The market's going further down at the moment to the lower quality resource companies, looking for value, and that's making it a bit harder for us. But we're always underweight resources. We've been moving in different types of contractors. Electrification is going to be huge, and there's going to be road bumps, speed bumps along the way. Southern Cross, Perth Ski, a great Perth company we think is undervalued at the moment, showing great margin expansion as contractors are getting more are seen as more valuable because there's not as many of them for all the work that's out there, and they'll be able to work on the data centers that are getting built. And I think they commented on unprecedented amount of work coming from the data centers. So we're positioned with a few of those contractors, but what we're always really looking for is having a diversified portfolio of well-run companies that we think are doing better than what the market expects. And the best way of explaining that is through their earnings. They'll generate more cash than the market thinks over the next 3, 4, 5 years. And so, yeah, as I said, Southern Cross, we don't have as big a weight as we used to, but Genus Plus, we obviously did very well. Another Euroz house name that's very well run by some guys a guy who's grew up in the industry of that electrification and rewiring Australia, which has got our infrastructure is falling to bits. So that's one theme. And a few of those software companies that we think are actually going to well, not software companies, but tech companies we think will benefit from AI. We haven't sold to zero, and that's where we sit at the moment.
Fantastic. My last question is, given the uncertainty around the world globally, does Ophir change their strategy at all? Do it remain true to form, stick to the knitting?
We stick to the basic strategy. So, what's going on at the moment, like while we're recording this, we're very plugged into what's happening in the US, and there's a huge degrossing that's happening from hedge funds because they had a very strong, they had very big exposure to the market, and they had been short, were betting that software companies were going down and they were going long on the chip manufacturers. And there's a big reversal of that now. It doesn't necessarily mean that the software companies are going to go higher, that they're actually doing better. But there is this sort of pain trade driven by Iran and the uncertainty of how this war is going to end without boots on the ground, be it Israel or the US.
Great, Andrew. Well, look, that covers it. I know we only had a short time, but I just wanted to say thanks, and that's a great update for all our listeners. And we really look forward to seeing you when you're over here in Western Australia at Rottnest Island.
I look forward to sharing a beer, but I know you're a popular man. Just pretend you know me when I come up and say hello.
Hey, thank you very much, mate. Appreciate your time.
Thanks very much, Tim. Have a good day. See you, mate.
Moving on to our next guest, we have Liam Donohue, who is the founding principal of Lennox Capital Partners and a portfolio manager for the Lennox Small Companies Fund. Liam, so great to have you on Finding the Front and the lead up to the Euroz Hartleys Institutional Conference. We can't wait to see you over at Rottnest Island. You've been to a few, Liam. You really love them.
I have, yeah, been to quite a few now. I've lost count of how many, but it's a pretty special couple of days, I've got to say. We and thank you for having me, by the way. We unfortunately don't get to do as many conferences as perhaps we used to in years gone by, but yeah, the Rottnest conference is a good one. It's locked in on the calendar, and yeah, I mean it's a great opportunity, from my perspective, to build relationships, no doubt about that, and that's on all fronts. It's with the corporates that you obviously have along attending the event, with yourselves at the Euroz Hartleys group who coordinate everything for us, but also the my industry peers, fund managers who attend the event. It is good to sort of hear their views on things and debate and discuss those issues. So it is a pretty special conference. But I would actually say, that's all well and good, but from an investment perspective, a big part of our process is assessing the quality of the people that are managing the businesses that we're investing in. And when you think about small caps, that quality of management piece, that can actually be life and death for the business, because the management do have such a big influence over these small companies. So even though it is a bit of an old school thing to say, you like attending conferences and spending time with people, having a meal, that is truly a huge help in terms of forming a view on the quality of the people we're dealing with. So it is a great event, hugely enjoyable, but also a really productive one from our point of view.
Oh, that's fantastic. I just can't wait to get into your thoughts on where we're at the moment. As a bit of an intro for all the listeners, Lennox Capital Partners is an active, fundamentally driven small companies boutique whose goal is to simply exploit inefficiencies in the equity market by identifying at an early stage sustainable companies that are beneficiaries of change. So, Liam, your single fund is the Lennox Australian Small Companies Fund. It was launched in 2017 and it's shown a return since inception of 9.28% net of fees. Do you want to give us a brief overview of that fund, just noting that your fund has no exposure to resources and what's been driving your performance over the last 12 months, particularly with the fund sitting around flat at the moment?
Yeah, no, you're spot on. Our sole fund is the small company strategy. We've been running that for coming up on a decade now, and you've touched on all the key points there. Ex resources, so industrials only, but as you say, the last 12 months has been a bit of a tricky period for us because being an industrials only manager, we do focus on fundamental research and bottom up stock picking. So we're a really hands-on firm in terms of that investment approach. And to start with, the past 12 months, it's probably been one of the trickiest investment environments that we've ever seen from our perspective and in terms of our process. And firstly, as you mentioned, small resources have massively outperformed small industrials. The small resources index has almost doubled over the past year, and when you look at small industrials over that same period, it's roughly flat. So that in itself is a pretty extreme level of outperformance, and it's probably about the biggest outperformance we've ever seen in 20 years of managing money. So that's been a big headwind. Yes. And then secondly, there's probably been a larger than normal number of macro level impacts on markets. And obviously that's continuing even now with the situation in Iran. And that has really overwhelmed stock level contribution to returns. So it's definitely been a tough 12 months for us. But I suppose the positive out of all that is then when we look back through history and look at the resources versus industrials piece, we know that through time, those two parts of the small cap market broadly deliver the same return, but the difference being resources do it in a much more volatile way than the industrial space. And that obviously makes sense when you think about mining and commodities being a cyclical industry, which typically goes through cycles of boom and bust. So resources are having a good run at the moment, and particularly gold. But history does show us that those booms invariably will turn into a bust at some point. So I suppose as an investor, the question you need to be asking yourself is whether at this stage of the cycle, you think the best use of your capital is to being exposed to resources after they've had such a strong run, or whether you would actually be looking towards a sector that, in a relative sense has underperformed, even though that return has been broadly flat for 12 months. But clearly has been left behind by that cyclical upswing, and that means obviously that you'd be looking for more exposure to the industrial space. And I suppose even if I can just keep rolling on there, Tim,
sure.
while I'm on a roll. The second part of that, just the mention of stock level contributions. That's something that we're really focused on in terms of risk management within the portfolio, and the reason we focus on that stock level risk being the main driver of returns as opposed to macro or market level risk driving our returns is that we actually want these individual businesses that we've done the work on and invested in. We want their business performance to be driving our returns, not whether we think the price of gold's going up or Australian interest rates are going up or down. We don't want the portfolio to be positioned so that those macro drivers are shaping our returns. So having said that, if we look at stock level contributors to our returns over the past 12 months, there's been a few names in there that are probably worth talking about, and the top three are SRG Global, Life 360, and Megaport. Many of those names would be known to our listeners, I suppose. But maybe in the interest of time, I'll touch on the first one there, being SRG Global, because it's a really interesting story in terms of what the business has delivered, but also in terms of our involvement in that business. And SRG are a diversified contracting business. They're based over there in Perth. They do a lot of work for large corporates, and that's right up to the major miners. But they also do a lot of what you'd say is probably less exciting work in areas like water infrastructure, maintaining utilities. So it is a diversified contractor. But going back to what we spoke about earlier, and forming that view on management teams of small companies, we met with the CEO and CFO of SRG, David and Roger, in 2018, so almost a decade ago. And at that point, the company had a market cap of a few $100 million. And it was clear to us even then, even though it was a relatively small business at the time, the guys had a really defined plan and strategy for how they were going to grow their business. And ultimately, they wanted to be multiples of their current size. And they had some really clear indicators, like moving into new sectors, deprioritising some sectors that they were currently participating in and didn't want to be in anymore, and also making acquisitions. So they were definitely clear that inorganic growth was going to be part of that story. And now, almost a decade on, we look back, and SRG have executed really, really well on pretty much all of those points. They're now almost a $2 billion market cap business, and they're about to move into the ASX 200. So that business has been a great performer for us and our investors. But the bigger picture is that we've engaged with that management team over a really long period of time and formed a positive view on them. And for their part, they were able to articulate their plan really clearly and then delivered on pretty much everything they said they were going to do. And the result for us is a really positive investment experience. So hopefully that gives a bit of a sense of what we're looking for in our investments and the stock level returns that we're really focused on. And I suppose also the patience that we need to show sometimes for some of those returns to be realised.
So Liam, that's a great overview. What are you sort of looking at for the next 12 months with this sort of current backdrop in mind?
Yeah, it's a really interesting question, and a sort of a tricky one for me, I've got to say, Tim. You're spot on. I mentioned before, we're not macro investors. We don't take macro views on markets or trade that way. So I'm probably the last person you'd ask for a view on market direction or the price of oil. But you're right also in that we absolutely have to be conscious of those factors. A 30% spike in the price of oil for a business that consumes a lot of oil or diesel, that can be a material increase in their cost base. So we absolutely have to be conscious of those macro moves when they are material. But perhaps from our perspective, what is possibly more interesting to talk about is how we're positioning the portfolio in light of those macro concerns.
Yes.
And so again, industrials only. So we're definitely not playing directly in the commodity space in oil or gas producers. But I suppose how we try and navigate these sort of extreme periods of volatility is effectively through consistency, and that really does sound simple, but it's often easier said than done. So similar to what we're seeing today and at other times in recent weeks, we're definitely seeing plenty of days where the screens are red, stocks are down 5, 10, 15%. Every so often we get a day with a bit of reversion and everything's green and we feel good about life again. But there is definitely that sense of heightened volatility. And I suppose how we play that is effectively by sticking to our knitting. But what that means is looking for opportunities in beaten up businesses that we may have had a positive view on, but perhaps couldn't get across the line because of valuation concerns. And if that stock is now 30 or 40% cheaper, but the outlook of the business is still positive, we're definitely happy to step into buying those sorts of investments. On the proviso, obviously, that the business meets all the criteria that we're looking for in terms of that positive view on management and the like. But equally as important is the flip side of that comment, in that we also want to be prepared for these sorts of periods. So prior to the volatility we're seeing at the moment, positions we held when markets were running and share prices were at all-time highs in some of the businesses we invested in, we had to stay disciplined and not get lost in that euphoria of strong share prices and actually take some profit out of those holdings, which we did quite a bit of over the past few months. So we're now in a position of having a pretty full war chest of cash that we are looking to deploy. And obviously, with a bit of a market shakeout, there are definitely a few interesting opportunities starting to pop up that we're doing the work on. So I think in terms of periods of volatility, we've got to make sure that we're not just looking at them as a time for nervousness and panic selling and hiding. Those periods can also be the times that you make some of the best purchases you ever make, because you're effectively buying businesses at probably irrationally low prices. So yeah, a bit of a roundabout answer, but we're thinking about markets constructively for this year.
Sure. Are there any areas or sectors that are jumping out at you at the moment, Liam, like from a value perspective? I mean, that listeners could look at for the next sort of 12 months that are on the radar, or any particular stocks in those sectors?
Yeah, definitely. And it is, further to your comments, Tim, it is probably one part of the market that we think about a lot in terms of sectors that have sold off, that have fallen a lot and may present opportunities. But I'd definitely say you want to tread cautiously, and that would be around the software sector and I suppose the tech space more generally.
Yes.
And everyone would have seen, the past few months with the so-called SaaS apocalypse, and anything to do with software was sold off pretty materially. It was in such a short space of time, it was a pretty savage sell-off, and that was driven by concerns around AI, which I think we all now probably agree, is seeing large scale and broad take up. It's no longer just a thought; it's becoming real. And there was that sort of next step or next logical progression of, if we're all adopting AI, something's got to make room for AI. So what's going to lose out? And yes, software was really, the first port of call, in that AI was going to replace a lot of the software we currently use. So we were seeing, everything from the online classifieds like realestate.com, right through to sort of specific software kit like Catapult and Bravura, Hub and Netwealth in the platform space. It was really widespread or broad brush. Anything to do with software was getting sold off. But again, out of that, there have to be some opportunities, not necessarily in the businesses that have been sold off, but undoubtedly opportunities. And what the market figured out initially is that even though software may be a bit of a sore point and may be disrupted by AI, what you absolutely can't disrupt and compete away is the need for physical digital infrastructure to support that AI growth and AI boom. And so further to that, one business that we think at the moment is right at the forefront of that trend and we're very keen on is a pre-IPO that we committed to about midway through last year. And that's a neocloud business called Firmus. And effectively what that business does is to use its tech combined with high-end chips from the likes of NVIDIA to generate computational output that ultimately is consumed in AI. So when you're entering a query into, say, ChatGPT or other AI engines, that query is essentially being passed on to the tech that's being run by Firmus and other similar neoclouds. They typically have space in large data centers, and that computing takes place. An answer to your AI query is put together, and then the response magically pops up in your AI chat. So Firmus is effectively a facilitator of the AI boom, and definitely a beneficiary of the AI boom. And they're not the first neo cloud operator globally. There are several of those, and many of them listed, but Firmus will be the first neo cloud listed on the ASX. And that process is due to take place over the next few months. And we do have a good exposure to that business in our small companies fund on behalf of our investors. So we're very excited about the prospects of that business. But also, just coming back to the question, they are emblematic. Firmus is emblematic of, I suppose, how the market is changing along with the growth in AI, in that focus is shifting from software players who possibly lose something when we move over to AI, and
Yes.
and the market, I think, is in the process of refocusing onto digital infrastructure and maybe more generally the businesses that are actually going to benefit from that AI consumption. So yeah, we're definitely looking in the tech space. There might be some beaten up software names that become interesting, although again, we'd probably say you need to be pretty selective there. But Firmus absolutely is our top pick within that space for the year ahead.
I know we've only got a short amount of time, but that was really, really interesting, and there's plenty to think about there. I'll wrap it up there, but just to say thanks very much. Can't wait to continue this conversation when you're over in Rottnest in a couple of weeks.
Absolutely. Look forward to it, and thanks for having me, Tim.
Good on you, Liam. Thanks again, mate.
Cheers.
Cheers. Well, our final guest for this episode is Matt Griffin, co-portfolio manager of the Maple Brown Abbott Australian Small Companies Fund. Matt joined Maple Brown Abbott in April 2022, bringing 17 years investment experience in Australian small cap equity portfolio management and fundamental stock research. Matt, so great to have you on Euroz Hartleys Finding the Front in the lead up to the Euroz Hartleys Institutional Conference. You've been coming for quite some time. You're back to something like 2009, thereabouts?
I think that's right. I can't remember exactly, but it does stretch back a fair while, Tim. Yeah.
No, it's great to have you on the show, and great that you can take the time out to share some of your insights into the investing climate. Just quickly, having been at the conference for that amount of time, tell us a little bit about your perception of it for those that haven't been there.
Oh, it's brilliant. I mean, it's one of the great conferences, I think, in small cap land, just getting everyone stuck together on an island for a few days, sharing ideas, meeting companies, talking to other funds. It's there's nothing else quite like it. So it's definitely one I try not to miss every year.
Look, a lot to talk about, but I just wanted to give the listener a little bit of background and around Maple Brown Abbott and your fund. So the Maple Brown Abbott Australian Small Companies Fund commenced in June 2022. It's actively managed and is primarily invested in companies which at the time they are first invested are not included in the S&P ASX 100 index and have a minimum market capitalisation of 100 million. So that fund is showing a return of about 22% since inception. I just want to start by you giving us a brief overview on that fund.
Sure, happy to, Tim. So this fund has been around at MBA for just over 3.5 years now, as you point out, but it was actually at AMP Capital before. So the team ran the strategy for 9 years at AMP. So effectively now we've got about a 12 or 13 year track record with the same process, philosophy, people. So it does go back a fair bit. Currently. So as you say, we invest outside the top 100 and down to about 100 mil market cap. So we're a long only Aussie small cap fund, typically investing in about 40 to 50 stocks at any time out of that universe of around 500 to 600. So plenty of opportunity for us, and it really just comes down to high conviction ideas in the fund. What we don't do is box ourselves into any style or thematic. So we're happy to go into growth, happy to go into value, industrials, resources. We just go where the earnings go. So earnings delivery is key for us and our process. Our philosophy, our history shows that companies that deliver on earnings outperform substantially in small caps. That's been the number one factor going back for the past couple of decades in this market. So we just try to find companies that can deliver on those earning streams, regardless of where they are in industries, cycles, growth value, all that kind of thing.
So how have you found the last 12 months then, Matt?
Yeah, it's been an interesting 12 months. The fund's done pretty well. So it's up about 30% in absolute terms after fees. That compares to the benchmark up around 22%. So that level of outperformance, 7.5% per annum, is about what the fund has done longer term over that 12 to 13-year period. What we aim for is consistency in returns. So we take a fairly heavy approach to risk management in the fund. We don't invest in stocks that have longer dated earnings that are unprofitable for the next couple of years. We don't invest in stocks with binary outcomes like mining explorers, biotechs, and we have quite a high filter on corporate governance, management alignment, and quality of the board. So that steers us into the kind of low risk end of the spectrum and some of the high quality stocks in the market. It's been an interesting 12 months, over the track record of the fund, because we go into all segments of the market. There's a wide variety of stocks and sectors that have contributed alpha over that time. But given what we've seen in the past 12 months, it's been predominantly resources, given that's where the returns have been, and some of the mining services contractors as well, which has been quite a big exposure for the fund. So if you look at the top 3 contributors over the past 12 months, it's the likes of Genesis Minerals, Codan, SRG, so probably stocks that are quite familiar to many of you listeners there. Gold's been quite a big weight in the fund, between sort of 10 and 20% over the past couple of years, which has been good. And a couple of tech companies as well, although that weight has fallen away a bit in tech as we took some profits towards the middle of last year. And there's been a bit of a tough performance in tech over the past few months, as I'm sure you'll be aware.
The market's become uncertain. Tell us a little bit about how you look to navigate the next 12 months in terms of your insights.
Yeah, sure. So I'll preface this by saying that we aren't macro forecasters. We don't think the 3 of us in the team have any particular advantage in picking the outlook for interest rates or wars or anything like that over anyone else in the world. So we are typically always fully invested. We don't try to time markets. We don't try to hold cash when things are down and time an entry back in. People are paying us and investing in our fund because they want small cap exposure. So we will find, and we always do find, stocks that align to that philosophy. Typically, when these big macro shocks happen, they can cause short-term issues in performance because the market doesn't focus on earnings during these periods. But as I said, we find that the best predictor of returns over time is companies delivering on earnings. So provided we can still go out, pick earnings better than the average investor out there, find stocks exposed to structural growth stories, different parts of the market that aren't affected by macro events, that's really the focus day to day, and that's what we are going after. If you look at the small cap backdrop today, we had a very good small cap outperformance versus large caps in 2025. Really made back a lot of the underperformance over the past few years. And then we've had a big reversal at the start of this year as macro worries, inflation, higher interest rates have all kind of come to a head and forced the small cap market down a fair bit over January and February. P ratio of small caps at the moment is 15 times. That's about a 20% discount to the 10-year average and about a 20% discount to where the top 100 is trading. So certainly today we see quite a good entry point from a valuation perspective for the market. But is it the right point in time from a political environment, from an earnings perspective? That's a bit more hard to predict at the moment. So I think what we're seeing is, if we enter this period where oil prices stay high for a while, there's instability in Iran and the Middle East for a longer period, that could lead to inflation, could lead to higher interest rates, could lead to tough economic growth, which is typically negative for small caps. And we kind of went through that period in 2022, 23. But what we're finding is that valuations are compensating for that. And when things do turn, they do turn quite quickly, as we saw last year. So not a great answer on where we're at this point in the market, but we do what we do. We don't change the process. We don't change the philosophy. We just try to find good companies that deliver on earnings, and at some point that will shine through.
Absolutely. Just out of interest, do you have any sectors that you think that might be of reasonable value at the moment, or sectors or stocks that you might be identifying as opportunities going forward that the listeners could just keep an eye on?
Yeah, quite a few more over the past week than there would have been about a few weeks ago, given the move. So there's definitely value out there. As I said before, value is kind of a secondary consideration for us. So we do focus on earnings. We tend to find that no matter how cheap a stock looks, if we think there's an earnings downgrade coming, or if an earnings downgrade gets delivered, that's typically never in the price. So valuation is not the primary consideration for us. We find that if we can pick stocks that will beat the market on earnings, that can be in growth, can be in value, can be in resources. Valuation can re-rate from a low base or a high base. It doesn't really matter what the starting point is, provided you pick the earnings right. So that's what I'll start with. So we do focus on the earnings, but from a valuation perspective, what's kind of interesting is there are sectors that are delivering on earnings but have had a big valuation reversal. Tech being one. We did reduce the tech weight in the fund quite materially about 6 or 9 months ago, just because we saw a lot of these growth stocks start to disappoint on earnings and the valuations are getting quite extreme. So a lot of them have been sold out quite heavily on that. We're starting to see a bit of value now and earnings support. I think the whole software is dead narrative, with AI and vibe coding has probably run its course for now. A lot of companies are coming out and fighting back against that narrative and actually showing that AI can be a cost benefit through cost reductions on the coding side or customer support. So there's stocks in that sector that we're starting to increase the weights on to find new ideas in. A good example being Euroz, stock I'm sure many people know well, being users of the product through financial planning or wealth management. That has been a pretty tough old business for the last probably 10, 20 years.
Yes.
What's really changed there is new management's come in and reinvigorated that business. The CEO has turned around 2 financial software businesses in the past decade. It's the same playbook with Euroz. It's a cost out story out of the G&A side, reinvesting in the product and marketing, showing better cash flow, showing better margins coming through. And we think that business is pretty well entrenched in its market segments and not really at serious risk of AI disruption. So there's an example there. The other side of things, I think we're getting some opportunities again in the cyclical space. How long, whether we're at a bottom now is hard to tell. If we do get this period of high oil prices, higher inflation, that can obviously knock cyclicals around for quite a lot longer. So hard to tell where the entry point is, but a stock I would point out here is Sims Group. Many people know Sims as a pretty low quality cyclical scrap metal recycler. What people hadn't appreciated until recently is that there's a business in there called SLS, Sims Lifecycle Services. They go into data centers and recycle old servers, repurpose and sell chips and components.
Right.
And you may be aware there's been this big super cycle and price spikes in memory chips at the moment. Essentially what's happened is all these AI data centers getting built out are soaking up DDR5, which is a new type of memory chip, DDR4, which is the old standard, which goes into your laptops, your mobile phones, your iPads, are now kind of no longer being produced. There's a massive shortage of them. And Sims is a massive beneficiary because they are picking these old memory chips out of old servers and reselling them at prices that are 10 to 20 times higher than they were 6 months ago. All the research, all the experts we talk to say this dynamic is going to persist for another 18, 24 months. So that part of the business is earning super profits. That's becoming a bit more appreciated by the market now. We think it probably extends longer than the market thinks and may extend to other parts of the hardware chain. And then I think in the medium term, the other things people aren't thinking about in the Sims business are the fact that there's structural tailwinds from China steel production potentially slowing in terms of the export market, the move to electric arc furnaces from blast furnaces, which is good for scrap steel. And Sims also has a property portfolio that was last valued at about $1.5 billion over a year ago. We think it's gone up since then. And I think in the medium term, there's a good prospect that it becomes you get a bit of a property division within Sims where they are recycling old sites, developing, selling them off. And that was a strategy which worked really well for some of the building materials companies in the last cycle, the CSRs, Borals, Adelaide Brightons. So that's the medium-term story there, which we think the market hasn't fully cottoned onto yet.
Good on you, Matt. I'm conscious that we've only got a short period of time, but look, we really appreciate you being able to share some of your insights and your knowledge with us and for all our listeners, and look forward to seeing you in a couple of weeks at Rottnest.
See you there, Tim. Can't wait.
Cheers, Matt. Thanks a lot.
Thanks. Bye.
Well, we really hope you enjoyed this episode. A fantastic opportunity to chat to leaders in their field and hear firsthand how they are seeing the investing landscape. Thanks again to Andrew Mitchell of Ophir Asset Management, Liam Donohue of Lennox Capital Partners, and Matt Griffin of Maple Brown Abbott for joining us for this special Fund Manager edition. It was just excellent. Signing off, and look forward to catching you for the next episode of Euroz Hartleys Finding the Front.
Thanks for listening to Euroz Hartleys Finding the Front. This podcast is for general information purposes only. Please check out eurozhartleys.com for more information. Euroz Hartleys holds Australian Financial Services Licence 230052.